All right, Gary Schlossberg is with us. He's Global Strategist at Wells Fargo Investment Institute. Gary, great to have you with us here. Thank you very much. Good to see you still with us all the way into the end of the year, Gary. No holidays, are
Still
you?
hanging in there, thank you.
Or is that
24/7.
does the background behind you hide the ocean behind or something?
It hides the rain.
It hides. All right, Gary. So how are things looking now? I mean, should we make anything? I was looking at two things. One is the crash in the stock price of Tesla. I was saying earlier that Tesla is not just an electric vehicle company, right? I call it talismanic Tesla because of the kind of cult-like following it gets out in people, especially in the US. It's like the beacon for retail shareholders in the US. And Tesla is down 70% from highs now. Is it telling you something about sort of sentiment, not institutional sentiment, but retail sentiment in the US? And what should we make of it?
Well, I think it's indicative of a more cautious attitude as we move into 2023. We have two uncertainties out there. One, the recent backup in interest rates. Some of that, of course, due to China, some of it due to the resilience of the U.S. economy. It is slowing, but the growth slowdown isn't quite as steep as we anticipated earlier. And that's made some people more believers out of a very hawkish approach by the Federal Reserve comments on the inflation outlook. So, and then just more generally, tech in general, with interest rates backing up, that may have spilled over to Tesla as well. So a couple of things coming together. We don't really see a sustained improvement moving through the early months of 2023, given the likelihood that a recession will be developing. And that, of course, is not great news for Tesla or any other consumer discretionary stock in that part of the market.
Okay. Gary, hi, good morning, and just the last few days of the year. So, I mean, it's festive cheer all around and wish you the best in 2023. Do you think it's going to be a good year for emerging markets like India? I ask because we've sort of managed to get out unscathed, right? The Nifty index is still down almost 8-10% in dollar terms, but nothing compared to what we saw in the US. You think things are going to change in 2023?
Well, we see an erosion in the outlook for India. Certainly no major change, but the delayed effect of interest rates, oil prices moving up. The big story, of course, is China. India has done well relative to China. Longer term, it may continue to do so as businesses begin to pull back, more of a secular trend. But a lot is riding on the outlook for China. There's a lot of euphoria right now. The country, the government has pulled back on that zero COVID policy. But for the next several months at least, there is going to be uncertainty as infection rates rise, what impact that will have on consumers, to some extent on supply chains as well. But I would say over the course of 2023, an erosion in India's standing. Valuations, of course, quite rich right now that could create something of a headwind. But again, I think the operative word is erosion rather than a full-blown pullback relative to other emerging markets.
Well, Gary, good morning. This morning I'm looking at the Hang Seng, which is up almost 2.5%, nearly 500 points in terms of gains, crossed the 20,000 milestone as well. In fact, this month it's been among the top performing indices in the world. After a spate of underperformance, valuations, a lot of people find, the Chinese and the Hang Seng markets to be a lot more attractive than India. Do you think we run the risk of flows being diverted to these markets as against India in the near future?
Well, certainly the attractive valuations, China relative to India at an extreme, is a potential headwind for India. But we first have to get through some of the uncertainties, I think, with China. As I mentioned earlier, the reaction to rising infection rates in the country. Will there be some reimposition of controls? Will consumers react to that? And then the property sector as well. Will that come back strongly? What does that mean for commodity prices? Still more questions than answers with respect to China. But the reaction is certainly understandable to an abrupt about-face, certainly more abrupt than we anticipated in China's zero COVID policy. And the gains in the Chinese market to date, I think, reflect that. Going forward, maybe more of a challenge as some of those uncertainties begin to surface in the market.
For cyclical sectors like global cyclicals like metals, Could there be more gains here because of, this reopening out of China? And oil, of course, is the other one, right? It's a huge market which has been out of global markets for a while. Maybe they've built up inventories, etc. But eventually, they get back in the oil market, and that means higher oil, not lower, right?
Well, we've seen oil already react to prospects for stronger growth in China. Again, a lot is riding on those uncertainties. That sustainability of the recovery in oil, in particular commodities more generally, will depend on the trajectory of growth in China. The government certainly will provide something of a tailwind with policy stimulus. China is in a better place. Their inflation rate is quite subdued. They don't have that hurdle for policy that the most other countries in the global economy are faced with, certainly outside of East Asia. So we're just going to have to see how that whole thing plays out. But certainly the potential is there for a mini rally at the very least in commodities going forward.
Okay, so there's a potential of a mini rally in the commodity space. So let's summarize this with some of your top picks of the year, right? I mean, which is the asset class you think could outperform in 2023? Which is the emerging market that could outperform? And what would you stay away from?
Well, we're still cautious on emerging markets. There still are some issues out there. Clearly, there is dispersion, the overall emerging market space. Their performance will depend considerably on China. But away from that, there are uncertainties in a more challenging global environment, the delayed effect of interest rates, foreign trade, perhaps losing some momentum as well. Our general view on emerging markets, while it is improving, is still somewhat unfavorable. We continue to focus on the U.S. market, the liquid stocks, the less economically sensitive stocks, as the U.S. goes through what we think will be a recession during the early part of the year. Healthcare, a defensive sector, low dividend yields, not susceptible to higher interest rates, energy stocks on strong fundamentals, and beginning to look at small cap and some of the more economically sensitive sectors, but not straight away. That will come as investors see some visibility of a recovery as we move through this recession that really hasn't developed just yet.